According to a recent report by Fitch Ratings, commercial real estate loan defaults are rising, and a sector expected to be hit particularly hard is multifamily. Here to talk about the challenges facing the sector is Mike Kelly, president and co-founder of Caldera Asset Management. Mike, can you tell me a little bit about what Caldera Asset Management does?
What we do is that we help clients with their multifamily problems, either over-leveraged assets or under-equitized partners or portfolios or platforms. So we help our clients are generally either the lenders or equity partners who have invested in deals over the past 3 to 4 years and have now, the world has slowed down, the profits aren't there, and now they have to adjust and address their situations.
How severe is the current default rate on loans in the multifamily sector, and do you see this getting worse?
I think the problem hasn't even come to the top yet. I mean, most of the loans you see in default were the ones that were just awful, just flat out. They were the 2007, 2008 vintage that should have never been done. The real loans that are going to come through will be the ones that have come through between 2010 through 2012, which were deals that were done from 2005 to 2007 that were either done with 5-year debt or 7-year debt that were well underwritten at that point in time, but the market has deteriorated. So the cash flow isn't available to refinance them, and you can't sell them in this marketplace right now.
And what do you see happening to this growing number of distressed assets that are in the market?
You're going to see the distress start with as you're seeing right now, the C's and the B's. The A's, you really haven't seen distress. The big question is going to be is that what happens to all these development deals? You have a tremendous amount of development deals all throughout the country that are coming through the system right now that historically they would already be bought. They'd be pre-sold to the different pension funds or the REITs. Well, that business has stopped. So now you have $3 to $4 billion of development deals that have no home. They have no natural home.
And do you see REITs being a likely buyer for some of these A-type properties that you talked about?
Correct. They'll be buyers. Well, many of the REITs have developed the assets as well, so they're going to have to re-equitize those assets. But also, they'll be buyers of many of these platforms and or mini portfolios that are going to come out that have to come out.
Thank you, Mike. For REIT.com, I'm Matt Bishard.